In the dynamic landscape of regulatory and listed entity audits, the cornerstone lies in grasping the intricate tapestry of corporate governance and audit compliance. How can organizations navigate this complex terrain effectively? By understanding the regulatory framework that underpins their operations and ensuring robust audit practices. Compliance isn't just a checkbox, it's a strategic imperative for fostering trust and transparency. From aligning with industry standards to mitigating risks, every audit step is a crucial stitch in the fabric of accountability. Let's delve into the nuances of this essential process, where meticulous attention to detail can safeguard reputation and drive sustainable growth. Welcome. Today, we delve into the world of securities regulation, starting with SEBI and listing regulations. Moving on, we uncover the vital role of audit committees in safeguarding investor interests. Then, we navigate through critical reporting timelines that uphold market transparency. Lastly, we explore why auditor independence is crucial for reliable audits. From regulatory frameworks to market deadlines, we're set for a deep dive. So, are you ready to unravel the intricate tapestry of financial governance? Join us on this enlightening journey as we decode the backbone of corporate transparency and accountability. Ever wondered who oversees the fair play in India's securities markets? Enter SEBI, the Securities and Exchange Board of India. Since its inception in 1992, SEBI has been the vigilant referee ensuring investor protection, market growth, and regulatory compliance. Think of SEBI as the guardian angel for investors, setting and enforcing rules that guarantee transparency and accountability. Without SEBI's watchful eye, the market would be a chaotic arena, leaving investors vulnerable to misinformation and governance lapses. SEBI, the unsung hero safeguarding the integrity of India's capital markets. Ever wondered how SEBI, the Securities and Exchange Board of India, safeguards your investments? Its core objectives paint a clear picture: protecting investors, especially those with limited financial knowledge, fostering market development with innovative products, and enforcing regulations that ensure fair play for all. SEBI is the backbone that balances market growth, investor protection, and corporate responsibility. In a world where financial jargon can be overwhelming, SEBI stands as a guardian, guiding investors through the complexities of the market. With a focus on transparency and integrity, SEBI ensures your investments are in safe hands. In the dynamic world of stock exchanges, understanding listing regulations is crucial for companies. The SEBI's Listing Obligations and Disclosure Requirements Regulations, 2015, known as LR, are a compass guiding listed entities towards transparency and accountability. These regulations mandate timely disclosure, uphold corporate governance standards, and safeguard investor interests. Companies must navigate through rigorous compliance obligations, ensuring continuous reporting and adherence to prescribed norms. Think of it as a playbook for maintaining listing status. Transparency, accountability, and integrity are the pillars supporting every listed company. Embrace the listing regulations to thrive in the competitive market landscape. Ever wondered how the governance structure of a listed entity really works? It all starts with the shareholder foundation, where shareholders have the power to elect the board of directors. This board holds the crucial responsibility of overseeing management and appointing committees, ensuring core accountability. The management and external auditors then report back, maintaining checks and balances. Notably, the audit committee plays a pivotal role, bridging auditors, management, and the board to uphold financial integrity and compliance. This structure is the backbone of a well-functioning governance system, ensuring transparency and accountability throughout. Ever wondered who keeps a close eye on a company's financial integrity? Enter the audit committee. This specialized subcommittee of the board of directors, a regulatory must for listed companies, stands as the vigilant corporate watchdog. Comprising at least 3 directors, with a key majority being independent, this committee ensures unbiased oversight. The chairperson, an independent director with financial expertise, leads the charge for objective scrutiny, shielding against undue influence. Monitoring financial reporting, internal controls, and audit processes, the audit committee plays a crucial role in upholding transparency and trust. Ever wondered what the audit committee really does? They're the financial watchdogs, meticulously verifying every number that hits the board's desk. From dissecting financial statements to selecting auditors and scrutinizing internal controls, they leave no stone unturned in the quest for accuracy and compliance. And when it comes to related party transactions, they're the guardians of shareholders' interests, ensuring fairness and transparency. It's a role that demands sharp eyes, a keen mind, and an unwavering commitment to financial integrity. So next time you see those quarterly reports, remember the diligent work of the audit committee behind the scenes. In the intricate web of oversight responsibility, the audit committee serves as a central hub of accountability. Engaging actively with various stakeholders, it ensures the integrity of the audit process. Through regular meetings with external auditors, independence and quality are upheld. Collaboration with internal auditors strengthens control systems. Management presentations offer crucial operational context, while board reporting aligns governance practices. The audit committee's role is dynamic, interwoven with distinct threads of assurance and insight. Are you ready to dive into the high-stakes world of audit reporting timelines for listed companies? These critical deadlines are the lifeblood of investor confidence, ensuring timely information flow. Miss a beat, and penalties, suspensions, or worse, delisting, may follow. To succeed in audit planning and execution, understanding and meeting these timelines is non-negotiable. Stay sharp, stay on time, and stay in the game. As the financial year draws to a close for most Indian companies on March 31st, a flurry of activities kick in to meet regulatory obligations. Within 60 days, by May 30th, audited annual financial results must be submitted to stock exchanges. The annual general meeting, AGM, must be held before September 30th, within 6 months of the year-end. Then, 21 days before the AGM, shareholders should receive the annual report with financial statements and the auditor's report. Finally, within 30 days of the AGM, proceedings and outcomes must be filed with the stock exchanges. Efficiency and timeliness are key in navigating this precise reporting timeline, ensuring transparency and compliance. Why does auditor independence matter? It's the bedrock of trustworthy financial reporting. An independent auditor offers an impartial view on whether financial statements reflect reality. Without this independence, audits lose their worth to investors. SEBI listing regulations and professional standards set strict independence criteria, safeguarding against conflicts that could jeopardize audit quality and investor trust. Simply put, independence ensures the credibility that stakeholders rely on for sound decision-making. What does independence mean for auditors? It's not just about having a clear mind, it's also about avoiding any appearance of bias. Independence in mind ensures objective thinking, professional skepticism, and a clear judgment unaffected by personal ties or financial interests. On the other hand, independence in appearance focuses on maintaining integrity and objectivity in the eyes of third parties. Even if mentally independent, any hint of conflict can erode public trust. Remember, both dimensions are vital for audit credibility. Stay sharp, stay unbiased, and always uphold your independence. What threats lurk in the shadows of auditor independence? Self-interest, where financial stakes sway judgment. Self-review, when auditing past work clouds objectivity. Advocacy, crossing the line to champion a client's cause. Familiarity, breeding bias through long client ties. Intimidation, silencing objectivity under management pressure. Guarding against these threats is vital for upholding integrity in auditing. How do we ensure independence in auditing isn't compromised? At the regulatory level, SEBI rules and Companies Act provisions set the tone. Within firms, quality control measures and ethics training play a key role. Moreover, through peer review and independent oversight at the engagement level, multiple layers of protection are in place. These safeguards are not mere formalities, they actively counter threats to independence. For instance, audit partners must rotate every 5 years, and non-audit services are strictly regulated. Robust quality control systems and ethics training further fortify independence. Independent reviews and audit committee oversight add another level of assurance. Independence is not a gamble, it's a structured defense strategy against potential risks. Takeaway: safeguards across regulatory, firm, and engagement levels form a robust framework protecting the independence of auditing practices. Ever wondered how auditors maintain objectivity when auditing listed companies? To prevent conflicts of interest, certain non-audit services are off-limits. Auditors can't handle accounting, internal audit, or management functions for their audit clients. No investment advice, legal representation, or valuation services either. These restrictions ensure auditors don't end up auditing their own work or compromising objectivity. So, while they provide essential oversight, they steer clear of activities that could blur the lines. Keep a sharp eye on the boundaries to uphold trust and integrity in financial reporting. In the real world of independence, consider this case study. ABC Limited seeks to engage their external auditor, XYZ and Associates, to revamp their accounting system and train their staff. Can XYZ accept this offer? No. This scenario poses a self-review threat as XYZ would essentially audit their own work in the future. This violates SEBI regulations and professional standards. The solution? ABC should engage a different firm for the system overhaul, preserving XYZ's independence as external auditors. Remember, maintaining independence is crucial for upholding ethical standards in auditing practices. Ever wondered how investors are safeguarded in the stock market jungle? Enter SEBI, the guardian angel of transparency and compliance for listed companies. But who keeps a watchful eye on financial matters? That's where the audit committee steps in, ensuring the numbers add up ethically. Time is money, they say, and listed companies must hustle to submit financial results promptly, no delays allowed. And speaking of integrity, auditors must be as independent as a lone wolf, with strict rules to ensure they tell the truth. In a nutshell, SEBI rules, audit committees audit, deadlines matter, and auditors must be true blue. Have you grasped the nuances of listed entity audits and regulatory requirements? Let's put your knowledge to the test with a few scenarios. Imagine yourself navigating through intricate compliance landscapes, where each decision holds weight. Picture the meticulous attention to detail required to ensure adherence to regulations. Now, consider the impact of a misstep in auditing practices on the overall integrity of financial statements. Are you ready to dive into the world of regulatory compliance and emerge with a deeper understanding? Remember, precision and diligence are key in upholding the standards that govern listed entities. Mastering these concepts will not only refine your skills but also elevate the trust and credibility in financial reporting. Welcome to our final slide, where we'll test our grasp on key concepts. 1. How many independent directors are required on an audit committee? At least a majority, meaning a minimum of 2 out of 3 members must be independent. 2. Within how many days must a listed company submit audited annual results? The deadline is 60 days from the end of the financial year. 3. Can an auditor offer bookkeeping services to their audit client? No, as this creates a self-review threat, making it a prohibited non-audit service. 4. What are the 2 dimensions of auditor independence? It's about independence in mind, mental objectivity, and independence in appearance, perception of objectivity. 5. How frequently must audit partners rotate for listed company audits? To avoid familiarity threats, partners must rotate every 5 years. In summary, understanding these nuances ensures robust governance and transparency.